What are the rules of a 1031 exchange? The 1031 exchange is named after Section 1031 of the Internal Revenue Code, allowing real estate investors to defer paying capital gain taxes. However, there are specific rules and requirements that must be followed to qualify for this tax deferral. Here are a detailed explanation. So the property must be purchased by the same party. So the first rule is the same taxpayer rule. The taxpayer who sells the relinquished property must be the same taxpayer who buys the replacement property. For example, if an individual named John Doe sells investment properties, John Doe must also be the one to purchase the new property under the 1031 exchange. There is exceptions. So certain exceptions apply for entity like single member LLC and disregarded entity, where the ownership structure doesn't change the taxpayer identity. The second rule is that you must file Form 8824 with the IRS. What this form is used to report the 1031 exchange transaction to the IRS. The Form 8824 requires detailed information about the properties involved, the dates of the transactions, and the amount exchanged. Filing this form correctly is crucial for the tax deferral to be recognized by the IRS. The other rule is that you must pay taxes on the boot if you have boot. Boot refers to any non-like-kind property received in the exchange or cash that is left over after the exchange. So this comes the tax implication, right? So if you receive boot in the transaction, you must pay taxes on it. The boot is treated as taxable gain. For example, if you sell a property for $500K and buy a new property for $480K, so there's the $20K difference, right? So this is considered boot and it is taxable. The next rule is the critical deadlines requirements. There is the 45-day identification period. So you have 45 days from the sale of your property to identify potential replacement property. The identification must be in writing, signed, and delivered to the qualified intermediary handling the exchange. There are some limitations. So you can identify up to 3 properties regardless of their value, or more than 3 properties as long as their combined value doesn't exceed 200% of the value of the sold property. There is the 180 days exchange period rule. So you must complete the purchase of the replacement property within 180 days of selling the relinquished property. So this 180 days period run concurrently with the 45-day identification period, not in addition to it. So what is the 2-year rule for 1031 exchanges? So this can relate to the related party transaction. So if the 1031 exchange involves a related party, the replacement property must be held for at least 2 years following the exchange. The definition for a related party is that those include family members, corporations, and partnerships with significant ownership overlap. This rule, its purpose is to prevent tax avoidance schemes where a related party attempts to use 1031 exchanges to defer taxes without generally continuing investment in real estate. With that, let's move on to the next video.